So I'm just gonna tell you how I met Jan Jordan, and then her daughter Kelsey. So a couple of years back, I had a client who really wanted to retire, um, but she couldn't afford to because her house payment was just too expensive. So she couldn't afford to retire. And that house she lived in had acreage, and so she couldn't afford the upkeep anymore on that home. And so um, it was just that she was in a conundrum. She couldn't really afford to like downsize, and she couldn't keep her property even though she loved it, but she couldn't take care of it anymore. Anyway, it was just this whole thing. And so I met Jan and learned about a little bit about reverse mortgage, and we were able to help her downsize, right size into a home that was a lot less work for her, but it was perfect for her. It was a house with a garage, and then it also had this little I don't know, workshop that had heat and air and power, and she was able to do all of her crafts and things that she wanted to retire and do there. So she was able to retire and not have a house payment and have the home that she was more comfortable in, and then have the flexibility to actually enjoy her retirement. So that's how we met. And I knew a little bit about reverse mortgage through that. But I have recently taken some classes and kind of learned a little bit more about all of the other ways it can help you as well. And so that's why I wanted to have Jan and her daughter on, because um, the reverse mortgage has gotten a really bad reputation over the years. And that was due to bad lenders doing bad loans. It has to make sense for the buyer who's downsizing, or for the person who's trying to stay in their home and needs money to live on. It has to make sense. The math does. And so that's why you really need to use a lender that specializes in reverse mortgage, because not everybody knows what they're doing. And then, the the client can then have negative consequences. And I think that's why it's gotten a bad rap. But when used correctly, there are so many things that this reverse mortgage, or I don't even, I don't even think it's called that, really. I think I'm saying that wrong, but we'll learn. But the options that it gives you, um, they're enormous, and they can really, really change people's lives and help them in so many different ways, especially as the baby boomers are aging, like my parents, and they live on this fixed income, and it just becomes a detriment almost. Like all of their choices are taken away. They either choose between food or medicine.
Yeah.
It's terrible what's happening. And so I'm gonna get a little bit choked up here because it's just a lot. It seems like every day I talk to somebody who's in a situation like this, and
Oh,
I
yeah.
want to get it out that there are choices, especially if you own your home. So with that, I'm just gonna let Jan and Kelsey kind of take it away.
Yeah. Thank you. Again, thank you. Yeah. So I'm Jan, and I've been doing reverse mortgages for 21 years, and Kelsey's my daughter. She joined me about 4 years ago. So I always say now, Kelsey kind of the brains of the whole operation. I just pick up the next phone call, and she does everything else. So I certainly enjoy working with her. And we work at Mutual of Omaha. So we're in the reverse mortgage division. We only do reverse mortgages. We don't do any conventional lending. And Mutual is considered a direct lender. So we're not a middleman, we're not a broker. We're considered a direct lender. And Mutual of Omaha, of course, offers the very traditional, familiar reverse mortgage. And then Mutual of Omaha does have their own proprietary reverse mortgage. We'll talk about that in just a bit, but that's just good information to know. So, Kelsey, if you want to bring up the presentation, we can get started. All right, so we're going to talk about the FHA reverse mortgage. And if you go to the next slide, so the agenda is that we're going to talk about how they work. We're going to talk about some of the guidelines, some of the ins and outs, so that we really start to get a concept on how these mortgages work. And of course, we've got to talk about the myths and facts of the reverse mortgage. They've been around so long, I think 37, 38 years. And so they've had a lot of time to have, good pros and cons, happen with the mortgages. And then my favorite bullet number 3, we're really going to get into some scenarios where somebody's buying a home and what does it look like if they pay cash for the home versus utilizing the mortgage. So that's our agenda for today. And when I talk, I'll really make a distinction whether I'm talking about the reverse mortgage for buying a home, because that is a whole transaction in itself, meaning you're selling your exiting home and you're going to use me as your lender to help you buy the new home. And then I will also make the distinction if I'm talking about, hey, I actually don't want to buy a house. I want to stay in place. I love my home. I don't want to move. I'm moving into retirement. And what does it look like to get a reverse mortgage, a refi, if I'm in my home and I don't want to move? So we'll really make the distinction in those two options today. Okay. So when we talk about the reverse mortgage, we talk about it as a very low risk government loan. It's a non-recourse loan, and I'll cover that in the very last bullet on this slide, but not quite yet. And the funds are not taxable. So a lot of times folks will say, well, does it have any tax consequence? Do I have to send anything to my CPA? And you don't. It is a loan. And because you're not making any mortgage payments, right? So the beauty of the reverse mortgage is you're borrowing money, but we're not asking you to make any monthly mortgage payments. So there's no 1098 we're sending you at the end of the year. So no tax consequence. And you can choose to use the funds however you want. And you can use them to buy a home. You can use them to stay in place and leverage your current equity position. And there's no prepayment penalty, because we know that sometimes circumstances can change in an instant. And so you can be in the loan 1 month or 10 years, or whenever you're ready to sell and move, you can. No prepayment penalty ever. And then we do have such a thing called a line of credit, and it's guaranteed to grow. And I'll talk about that a little bit more about what it means to have your line of credit grow. Now, back to that word non-recourse. So the non-recourse means that someday when you're selling your home, if the loan balance got bigger than the home value, you, the homeowner, don't owe more than the home's value. So that's protection, right? You want protection for you or your family when you get into this mortgage. Now you're going to see here again when we start to get into the numbers is that we're going to loan you just a portion of your home value, because we want to someday when you sell the house, whether it's 2 years from now or 22 years from now, we want to have only loaned you enough so that there's always going to be equity. We always want you to sell the home. We always want to have home equity for you. And again, we've got some real good slides coming up. Okay, so most common uses. So a lot of folks these days, I'll say a lot of us baby boomers, I'll include me in on that. We know that we can approach retirement and still have a mortgage payment, or maybe we're already in retirement and have a mortgage payment. Now, you can imagine if your mortgage payment's $1,500 a month or $2,000 a month, and you're now retired, you're now on a fixed income. If we could eliminate that mortgage payment, if we're eliminating, let's just say it's $1,000 a month. If we can eliminate that mortgage payment, that's $12,000 a year that you're not mailing off to a lender. And you can really start to see how important it becomes to enter retirement or get into retirement and not have a monthly mortgage payment. Because, for instance, if you're keeping $12,000 in your pocket each year, and let's just say you're in that home another 10 years, that's $120,000 that you've kept in all your retirement funds, all your retirement buckets in your hands. You have not mailed it off to a lender. That's the huge that's the huge point of why a reverse mortgage becomes important, is getting rid of mortgage payments. And then it can provide a line of credit for future needs. Again, we'll talk a little bit more about that. But if again you're on fixed income, maybe you have Social Security, pensions, IRAs, and you can have a line of credit, a reverse mortgage line of credit, it just is an added bucket that you can now move between. Maybe you don't want to pull from your IRA, maybe you want to pull from the line of credit. Especially if the markets are down, the last thing you want to do is pull from a bucket that's moving downward. So again, it gives you flexibility in retirement. And then, of course, purchase a home without spending all your cash. And again, we've got some great slides coming up to look at that. So again, using a reverse mortgage to stay in place or buy. So common uses, sometimes consolidating debt, paying off some cars that you might owe. Sometimes our clients have some credit card debt that's been adding up. So again, being able to get those expenses under control. Supplementing income. Kelsey and I do talk to clients that they really are truly trying to live on Social Security each month, and we know that that is a tough position to be in. So being able to supplement income. Bullet number 3, again, we talked about retirement planning. Again, an IRA, a 401k, some savings, and possibly a reverse mortgage line of credit. And then again, remodeling our homes, home repairs, maintenance. Again, clients, if they're moving, they might be moving to a home that doesn't have those things. But if they're in a home and they want to stay in place, a lot of times being able to do a little bit of remodeling, home repair, that kind of thing is important. And then, oh my gosh, healthcare costs. Again, we know that there are times when Medicaid, Medicare is not going to be paying for everything, or prescriptions are out of control. Again, just being able to leverage and being financially savvy with your money. And then long-term care. I mean, nobody wants to think about long-term care or in-home health care, but at some point, maybe somebody's fallen, broken a hip, that kind of thing. And again, being able to stay in your home and supplement with some in-home health care might be important. And then cash reserves. And my example, and Kelsey always laughs at me, my example is the darn hot water heater always goes out at the most inconvenient time, right? And boy, that can be 3,000 ish or more dollars to replace a darn hot water heater. So again, if you're trying to live on Social Security or pension, sometimes those are catastrophic because nobody has those kind of expenses. And then of course, let's talk a little bit about fun, being able to maybe go out to dinner and not have to worry, or be able to go visit family or great grandchildren or grandchildren, that kind of thing. And then of course, purchase a home. Now we always say downsize, but actually today we really try and use the word right size, because you might not be downsizing. But moving closer to family, moving closer to doctors, moving closer or moving away from yard maintenance, that kind of thing. So patio homes, that kind of stuff. So those are some of the common uses. Okay, so we're now going to start to get in the weeds a little bit, but here we go. Okay, so what's a reverse mortgage? By the way, reverse mortgage, we know it as a reverse mortgage. The official FHA loan name is Home Equity Conversion Mortgage, also known as HECM. So if somebody's saying the word HECM to you, or Home Equity Conversion Mortgage, It's all the same. It's a reverse mortgage, okay? Or even the word lifestyle loan. Those all mean the same thing. It means I'm borrowing money. I never have to make a mortgage payment. I have to be 62 or older, and I always remain on title to the house, and the house is always yours. You're always on title, not the lender. And here, quick sidebar. Mutual of Omaha has their own reverse mortgage. I said that earlier in our presentation. And it does lend more money than the FHA loan. Now, because of that, the rate is higher. But there is no mortgage insurance premium because it's not an FHA loan. So it's our money, our loan stays in our portfolio. And so there's different pros and cons. So when we're talking to a client, whether it's I want to stay in place or buy a home, we always show them what the HUD or the FHA loan looks like. And then we do, if it's appropriate, we do show them the secure equity so that as the consumer, they can look at it and say, what's most important to me? Bringing the least amount of money to the table if I'm buying a home. Is interest rate the most important? Is lowest closing cost most important? So we give them options because as a consumer, we don't know how they might be shopping. But anyway, I just wanted to let you know that Mutual of Omaha has their own. But the rest of the presentation will just be talking really about the HUD reverse mortgage. Okay. You have to be 62 or older. And it does have to be your primary residence. Primary residence for us means where do you live 6 months and 1 day out of the year? Because we really do take into consideration if you're a snowbird, you like to spend your winters in Florida or Arizona. So 6 months and 1 day. And then we do, like any lender in the nation, we do want to make sure we're pulling credit. We're looking at where your money is. We want to make sure that you are a good steward of your money, of course. So we're going to do a financial assessment. We just talked about living in your property as your primary residence, and you are going to pay your own property tax and homeowners insurance. We don't escrow. And then we do look at the youngest borrower's birthday. Now, the reason why we look at the youngest person's birthday is because it's calculated that the youngest person's possibly going to be in the loan the longest. And so that's why birthday becomes important. Excuse me. So when we start to look at how much you're eligible for, there's a couple key components. I want to know how old the youngest person's birthday or the youngest person is. And then as we're talking in the very beginning, we're going to do a best guess on home value, whether it's the home that you want to be purchasing or the home that you're in. And so those two factors, I plug them into this calculator, this software that we use. I plug in birthday and home value, and it literally spits out how much money we can loan. So that becomes important. And then how you receive your money really is very flexible as to you, the borrower. Monthly payments, lump sum, line of credit. Of course, if you're buying a home, I'm bringing all my money to the closing table, but very flexible on how you get all that money. One quick anecdote here. Let me give you an example of what it looks like to stay in a home, okay? Just so that I can talk about and give you an example of what it looks like. If I had $100,000 home, so that my home's 100,000 and I collect your birthday, and according to your birthday in the calculator says, okay, I can loan you $40,000. And you say, oh, but by the way, I have a $10,000 mortgage. I say, okay, The capacity that I can loan to you is $40,000. But before I give you access to all that money, I'm going to take $10,000 and I've got to go pay off your current mortgage. I've got to get rid of that mortgage. And then I've got another $30,000 that I can put in a line of credit if that's how you like it. But I've done two things now for you. So if we just pause for a second, what has the mortgage done for you? Well, first off, it's gotten rid of your current mortgage of 10,000. So whatever you're paying each month on that mortgage payment is now going to stay in your pocket. So financially, that's your first lift. And then I've now got $30,000 I can put in a line of credit. And remember, a line of credit is just that. It's a bucket of money. Until you pull money out of it, you don't owe it. So it's a bucket that's sitting there because maybe by just getting rid of your mortgage payment, you don't need to pull any cash out of your line of credit this year, next year. But who knows? But it is sitting there waiting for you. So financially, that's what we've done for you. Okay. Well, of course, there's safeguards. Well, we already talked about the HECM being a non-recourse loan, so we won't cover that again. The homeowner retains title, right? So you're always on title. It's always your home. It's not ours. If you are passing away and the home moves into your estate owns the home, not us. As any lender in the nation, of course, we go down to the county and file a lien just so that someday when that house is sold, everybody knows that a mortgage needs to be paid off. And then third-party counseling is required because HUD wants you to see and hear the pros and cons of the mortgage from somebody other than me, the lender. So it's phone counseling. It is phone counseling, 30 minutes long. The counselor's just going to review some items with you. They're going to tell you this and this and this, and then they might ask you a question. But it's just so that you're hearing it from somebody other than the lender. Another nice component is that if you have a line of credit, it could never be canceled by the lender. It can never be frozen or reduced. So once we close that line of credit, it is there, it is yours, however you might want to use it. And then we talked about the line of credit can grow more each month, meaning the line of credit is always going to grow 0.5% more than your interest rate. So today, if your rate on your loan is 6, you've got your line of credit growing at 6.5. So again, it's a way to increase your borrowing capacity over time.
Okay, can we go back? I just have a question about that. So, because I think we use these words and it doesn't always sink in, especially when we're
Yes.
talking to the public. So, you're blowing my mind here. So, regardless of the home value. Okay, so I know this is being recorded and I'm still taking crazy notes because that's how I remember. But so on your example of the $10,000 home that had a $10,000 mortgage on it, you were able to give them 40,000 in the reverse mortgage or line of credit. You
Yeah.
used 10 of that to pay off the mortgage. So then they no longer owe their $1,000 monthly payment or whatever it was.
Yes.
Okay, so that stays in their pocket every month going forward. Then they have a 30,000 line of credit left, and they can use that on anything. They can use it on travel, healthcare, to pay their taxes and insurance on the house, to all of those other things you said, buy a car if it breaks down, whatever. Um, so they have that money and they can use it or they don't have to. It can sit there, right? And they don't owe it, but it's available to them if they have an emergency. Am I hearing that right?
Yep.
Okay, so then if I'm just kind of processing this myself to talk to clients about it. Um, so then say I have to use all that 30,000 for
Okay.
whatever it is. But it's taken me 10 years to do that, 10 years to burn through that 30,000. My line of credit, that 30,000 has grown 0.5% interest,
Yes.
regardless of my home value going up or down. So
Yes.
I probably haven't burned through my whole 30K because it was growing for those 10 years.
Yeah.
Okay, that's crazy. And it can never be frozen, canceled, or reduced. So that blows my mind because I've had credit cards and debt and I've gotten in
Yes.
trouble before, like many of
Yes.
us, no shame. Um, and they go, you have a $10,000 credit limit. Oops, now you have a $6,000 credit limit.
Yes.
And to no fault of my own, I've been trying to do everything right. So you're saying this line of credit, they can't cancel it, they can't reduce it, and they can't freeze it.
Yes.
Oh my gosh. Okay. I know I'm just repeating this, but it's sinking in. Um, okay. And then you said the homeowner, so let's see, what was the bullet? The homeowner or estate is entitled to any remaining equity. So
Yes.
explain that to me using our example if
Yes.
we didn't use the 30K.
Let's go. So back to the $100,000 home, and I loaned you the 40,000. Okay. And let's pretend you did use all 40,000. And in 5 years, you're ready to sell and move on. Okay. So in 5 years, remember, you owe me $40,000. And as a lender, my money's not free. So let's just say there was $5,000 of interest. So you owe me 45,000 in 5 years when you're sitting at the closing table. Now, however, that's no longer a $100,000 home. 250, $275,000 home, maybe even 300. And whatever you're selling it for, I only want my $45,000 back, and the rest is your equity.
Okay. So we used all the money, plus we have to pay you interest on the money we used. But my $100,000 home is probably worth 200,000 now or 150, whatever it is. So I get a great agent, I sell my home, and I only owe you $45,000 of the remaining
Yes,
balance.
yes,
Okay, and I can give that to my kids, or my kids can sell it after I die
yes,
and they
that's
can
their
get that money.
inheritance.
Okay. Or I can use it. Okay, this is crazy. Okay, this is just so cool. Sorry for interrupting. I just need it. Sometimes I'm a little dense sometimes. So
No problem, no
cool.
problem. All right, Kelsey, you want to go to the reverse mortgage for home purchase slide? So we're going to change a little bit here, and now we're going to talk about buying a house. I want to buy a house. So if we look at our bullets, we can help your purchasing power, right? Because you're going to have a net from your exiting home, and it might not be enough to pay cash for a home. And we are, as a lender, able to come to the closing table and help you increase your purchasing power. I'm going to show you some examples in a second. It reduces your out-of-pocket cost, right? Because I might not need all the money from your exiting home to buy the next home, which then increases your cash flow. And again, no monthly payments. Again, you've got some liquid money. You're just not taking all your money and sinking it into a house, a cash transaction. So Kelsey, if you go to the next slide. So just like a regular mortgage, the way that it works is that, again, no monthly payment required. You are going to pay your property tax and homeowners insurance, and it increases your purchasing power, which if we go to the next slide, I will show you kind of what I'm talking about. So here's a wonderful matrix, and it's a little bit generic, but along the top axis, it has age of borrowers, 62, 65, 70, and so on. And down the left-hand side is purchasing price. So you can see that we've got a purchase price of 600 there highlighted. And if you were 70 years old, I would need you to bring 397,000 to the table to put you in a $600,000 home. And I'm guessing, and 99% of our clients, that 397,000 is coming from the exiting home.
We have two different clients that use the reverse mortgage for purchase. And essentially, they were saying it's life changing. I know that that's a very grand statement, but it was life changing for them. They were able to keep money in their pocket and purchase a new home. They were right sizing into a home that more adequately fit their lifestyle in retirement without having to sink every single dollar into that purchase. We all say, oh, cash is king, but keeping cash on hand is even more powerful than sinking all your cash into your home. So with these clients, they talked about some of them were able to, they had $68,000 of upgrades that they were actually able to do in their home because they had that cash available and on hand rather than purchasing every single penny with that home. And the other couple was talking about how they were able to use those remaining funds for a little fun money. They booked a cruise. And again, the biggest benefit is they're in this home now without having to make a mortgage payment. There's not cash going out each month. They're more secure when they're living on this fixed income without having to make that mortgage payment.
I'm going to show you the amortization table.
Cool.
So this is Mary. She's 70. She wants to downsize, right size, move closer to family, and she has a mortgage. And she has to get out of that mortgage payment because she's already 70. She has our standard Social Security and a very small pension. So if we go to the next slide and say, okay, well, let's look at Mary buying a home. And so in the upper box, you see that Mary is selling her departing home for $700,000. Okay, wonderful. Now, we always add, in the very beginning, I'm always going to add 6% realtor commission. So we know if Mary sells a $700,000 home, we've got $42,000 of realtor commission, and there's that darn mortgage that we've got to pay off. Mary's still got a $100,000 mortgage. So when she's done with that transaction, she's standing there and has $558,000, and she's got to go live somewhere. Well, Mary says, oh, I want to buy a house for cash. Okay, so let's look at the left-hand box down there called option 1. Mary says, I want to buy for cash a home, and she wants to buy $550,000 home. Well, that makes sense. She's got a net of 558. That's a great decision. She's in her home and she's got an extra. And by the way, that shouldn't read $80,000. That should only read 8. We got an extra 0 in there.
That's okay. I can't math most days, so.
But she's in her home, free and clear. She's got an extra $8,000 to buy some rugs and carpet and drapes, whatever she wants to do. Wonderful decision, but there is a different decision she could have made. Option 2, that's the bottom right-hand side. She's going to use the HECM for financing this new home. She's still going to buy $550. And look at the third row down on that. Cash down payment from her exiting home. I'm going to ask her to bring $354 to the table. I'm going to bring the rest. And she's in her reverse mortgage, and oh my gosh, look at the net. I've left her with $200,000. And remember, we just said she's on a small Social Security and pension. 200,000 is going to make all the difference in the world to her.
Oh my gosh. So,
It's a different decision.
right. It's just using your tools differently. Another option.
Yes, yes. And Kelsey, I'm starting to watch my clock. If you want to go to Fred's, then we'll do Fred's and look at an amortization table. Fred is 67, so he's a little more younger in the reverse mortgage world. Fred wants to upsize. He's ready to move on. So Fred does have Social Security, and he does have a wonderful 401k of 300,000. So let's see what Fred's options are. So again, in the top quadrant, Fred has got a $550,000 home he's selling. Now, Fred doesn't have a mortgage. So with our realtor commission of 33,000, Fred is standing there with 517,000. But remember, Fred wants to upsize. So look at this. The new home purchase price. Fred wants to buy 750,000 and he's only got 517. So Fred needs to go pull 233,000 from somewhere. Well, the only place he can pull that from is his 401k, which that's not what you're supposed to do. That's not what a 401k was designed for.
And it was only 300,000, right? So, I mean, that's using almost all of it.
Almost all of it. Yeah. And especially when you know that 401ks are not, they're pre-tax. So he's going to wipe out his 401k. But what's Fred's other option? Because he's going to upsize. He's moving to the golf course. So Fred's option number 2. He's still buying that 750. And look at the third row down. Cash down payment from Fred's exiting home. I'm going to need him to come to the table with 486,000. And we know he's got 517. So he's leaving his 401k intact, and he has a reserve of $32,000. It's a different decision.
Plus his 401k. Yeah, like you just said, he has that 300,000 plus the 32. And there was no tax consequences.
Yeah.
Was there on this option
No.
2?
No.
Okay. Wow.
So if you go, this is the slide we've been waiting for. Okay, this is an amortization table. It's a little bit like an eye test, but let me just show you a couple things. The second column from the right-hand side says property value. And we know year over year, the way that these loans work is that homes appreciate, and we use a standard national home appreciation of 4%. So you can see down there at around 74, 75, Fred becomes a homeowner of $1 million home. Okay. Now, if we look at loan balance is smack in the middle of the screen. Fred is going to owe about 493. He sells the home. If he's selling, he sells the home for $1 million and change. 493 is due. And look at that. He's got over $500,000 of equity. Now, if Fred's estate is selling the home, he's left $500,000 in his estate. Or if Fred's moving to independent living or wherever he's going, that's how he's paying for it.
Oh my gosh.
So this is the slide that just makes most of the difference for everybody, because everybody has in mind that by the time they sell their house, it's going to be underwater. And it's not. We're only loaning you a portion of your home value. And I think a lot of times people forget that homes appreciate.
Right.
I see that Candace had a question. Candace, do you still have that question? I saw your hand go up.
Yeah, you can unmute yourself.
Oh, thank you. I was just wondering, what are the closing costs for the loans?
The closing costs, yes. So let me, closing costs. Okay, I can rattle them off to you. We don't actually have them listed.
They are listed on here, Jan. They're up here in the top right.
Oh, there we go. There we go, Candace. Now, the biggest portion of that closing cost is, because these are an FHA loan, FHA charges 2% of home value at the time we close for mortgage insurance. So 2% of 750 is 15,000.
And then
So
plus
that's
the
the
real estate costs,
majority. Yep.
or just the other, what's the remaining 20?
The remaining is, as the seller selects the title company on a 750 house, let's just say that it's about 3,500 for recording, title, notary, appraisal, pulling credit. And then there is always a $6,000 origination fee for Mutual of Omaha, because we're normally buying down that rate.
Okay.
That's the three closing costs. MIP, 2% of home value, a 6,000 origination, and your standard closing costs 3,500-ish.
Okay. Okay. So if, say we were doing this not with the Mutual of Omaha proprietary program, would they not be charged that 2%
No,
FHA
that's
MIP?
not there. That's not there on our proprietary.
So it would just be the origination fee and the normal closing costs.
An origination fee does move up and down on the secure equity, again, depending on what the loan looks like.
Okay. And
Yeah.
so, and how do you, so the rate, I know you said it's higher on the
Yes.
proprietary program. So how does it even, I mean, is it a wash whether you go FHA or the proprietary, or what makes the
Yeah.
biggest difference
So
there?
most people don't shop interest rate. So again, that's hard to understand if you're talking about conventional lending and I'm a realtor and that's all I've ever known. Most people are shopping, how much money do I bring to the table? Because I don't have that much money to bring to the table, or I'm only getting 200,000 and I only want to bring 100 to the table. So the difference in interest rate, I can tell you, the proprietary rate is in the 8s and 9s. And the HUD reverse mortgage, the FHA reverse mortgage is in the 6s.
Okay.
But the difference in the amount of money you can bring is tens of thousands.
Right. Okay.
So some people say, gosh, I want this house. I don't like 8 or 9%, but I can only bring this amount of money to the table. So yes, I'll take this. I'll take the proprietary.
Gotcha. Okay. So it really affects what you're bringing to closing.
Yeah.
Yeah, and
Okay.
we just had clients who purchased a home in Fort Lupton and they decided to go for the secure equity. They said, we have heirs. Of course we want to, pass on as much equity to them as possible. But for us right now, secure equity makes more sense because it required them to bring about $75,000 less to the table
I
than our
see.
FHA product.
I see. So that's why it's just so important to sit down with you guys and compare the options.
Yeah.
Yes.
Right. Oh, I love that. I love that you're not hiding anything, and pushing your proprietary, or one or the other, that's what makes such a big difference in lenders you can trust and that have been doing this a long time and know what they're doing.
Yeah. 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 It's really the consumer, the borrower's choice.
Okay,
So
that's
Kelsey, we've got about 5 minutes. Candace, of course, if you've got questions, holler out. I'm going to rattle through these last few myths.
and we do
slides.
Okay,
have,
great. Thank you.
and Candace, we'll stay on for about 15 minutes after. So we'll let her get through her presentation, and then we can ask all the questions we want, which I should have reminded myself because, I've taken up a lot of time asking questions.
All right, so the lender owns my home. We've already talked about that. Nope, it's your home. Moves into your estate. Yeah, we have a lien filed at the county. The funds we received are taxable. Nope, we already covered that one as well. We did a good job there. Reverse mortgage, they're risky. Funds are not guaranteed. Again, we've talked about that. Reverse mortgages have changed over the decades, and of course, completely overhauled during the 08-09 meltdown of the nation's economy. So again, like any lender, we've got tons of documents, and things have really changed. There's no equity sharing that the lender receives. It's just you pay me back what you owe.
And if you can't pay me back, oh well, it's not
It's a
recourse.
non-recourse loan. Yeah. Oh, and yeah. Yeah. And we covered that well too. All right, Kelsey, next slide. All right, myth number 5. When it becomes due, the lender takes or sells my home and my heirs lose. And again, just to be very clear, the whole premise is that it is going to move into your estate. You've worked hard your whole life trying to get this house paid down. And yes, you want to be able to leave some money to your estate. And hopefully I showed you in that one amortization table, whether it's tens of thousands or hundreds of thousands, we're just going to loan you a portion so that there is going to be money for your inheritance. And then myth number 6, um, what if I outlive? So I don't think I mentioned it yet today. These loans are due on your 150th birthday.
Oh,
So it is
wow.
not a 15-year loan or a 30-year loan. If you're in the reverse mortgage, by golly, you're good. You're golden. And then you can never get out of a reverse mortgage. We did already cover that. There is no prepayment penalty. Your life circumstances could change a month from when you got in the reverse mortgage, and there is never a prepayment penalty. Oh, yeah, this one's good. We haven't covered this one. It can impact my Social Security and Medicare benefits. Nope, it cannot. It is a loan. It's not considered income.
Wow. That's huge.
Yeah. And then what happens at the end? The heirs can keep their home if they want. We really haven't talked about that. They would have to satisfy whatever's borrowed, whether they're going to get their own loan or maybe there's life insurance money, or they can simply put the home up for sale. It's their option. When the last survivor passes away, the heirs do have 12 months to sell that property, which will repay the loan.
Okay, so you said the loan comes due on the borrower's 150th birthday. Is that the oldest borrower or the youngest?
It is the youngest.
Wow. So even if your spouse is, I don't know, way younger than you and you live a long time, they cannot outlive their house either.
Nope.
Oh my gosh. Okay. And then so what is one example of like, is there an example of we lived too long or we used all our money and we were dumb. We went on all sorts of cruises and vacations instead of using that line of credit wisely, which we can do that. We just can't do it crazy, right? So is there an instance where you or your heirs would have to just give the keys to the bank and walk away, not owe anything because it's non-recourse, but would there be an instance where we didn't use our funds correctly and we would have to just give the keys and walk away?
So there might be a point in the loan where that loan balance got bigger than the home value, but we as a lender would never know that because lenders don't have the capacity of the million loans that they have out there to keep track of all that stuff. We just know that someday you're going to sell the house. And we don't know if you're going to have equity or not. We're hedging that you won't have equity or that you will have equity. But we don't know that until you go to sell the house.
Right. So the only way where you might not, or you and your heirs might not have, I just like to get the worst case scenarios out of the way, right? So might not have anything left over is if maybe the market was to totally crash right
Yeah,
before you died
absolutely.
or
Another
something.
2008, 2009.
Hmm. Which would be very unlikely
Yeah,
because you guys are hedging that even if there was a crash throughout the years, it's still gaining equity.
yeah, yeah.
And to
And
add
believe
on to
me,
that,
go ahead.
oh, I was going to add on to that. Let's say we have that couple that they've completely drained their line of credit. They went on cruises, or maybe they had huge medical expenses. They pulled everything from their line of credit. There is the opportunity when market conditions are right, when appraised values for homes have increased, to refinance your reverse mortgage.
Really?
So we just had a client in December. They had used all of their line of credit. Their daughter was going through a divorce. and they wanted to help her out financially. They called us to ask about refinancing their reverse mortgage, meaning they want to be able to tap into even more equity. We do have to run financial tests to make sure there is a bona fide financial benefit for to refi their reverse mortgage. But we were able to run those tests. They passed those tests. We refinanced their reverse mortgage and were able to give them additional money in the line of credit that they then turned around and used to help their daughter as she was going through the divorce.
How does that work? If they used all of their credit and they refinanced because they needed more money, that's not making sense to my brain.
Yeah, so when we originally closed their loan, we had their home value, let's say, I can't remember off the top of my head, but I'm going to use their home appraised for 500,000. When we closed their loan, the rates were a little bit higher. It was about a year or two ago, the rates were higher. When they came to me, our rates had come down a little bit in December, January. We saw rates coming down a little bit. When rates come down, we have the capacity to lend more money. Not only were we having the capacity to lend a little bit more money, the appraised value, when originally it was at 500,000, 2 years later, their appraised value now came in at 625. And so with that higher home value, a little bit lower interest rate, we were able to lend more money. So
Oh,
that was the way that situation worked.
that is insane. I love mortgage math. I don't understand it, but I love how it works.
We won't say you're a nerd.
Well, yeah, I can be. Yeah. I just wish I had more of a math brain because I love the puzzle pieces and how to move things around and make it works if you can for the people that need it.
Yes,
You know, that's
yes,
just what
yes,
it just that my heart is so big for that because we
yes.
all know somebody who's struggling. And
Oh,
if they
yes.
have money locked up in their home, they don't have to be struggling.